Welcome, everyone, to Wealth Capital Management's Q2 26 Financial Markets Insights webinar. My name is Remington Borg, and I'm the Portfolio Administrator here at Wealth, and I'll be your host for today's session. If you have any questions that come up during or after the presentation, please feel free to drop them in the chat, and we'll make sure they get addressed. We're glad you're here today, and we think you'll find today's discussion to be both timely and valuable as we unpack what's happening in financial markets and what it means for long-term investors. I'd also like to take a moment to introduce our newest addition to the Wealth team, Rex Weeks, our newly appointed Chief Investment Officer. Rex holds the CFA designation and comes with deep experience in portfolio management and investment strategy. We are thrilled to have him join the team, and we look forward to the leadership and insights he brings to managing our clients' portfolios. Also joining us today is Sean Kennefic-Rogers, our founder and CEO. Sean holds the CFA designation and brings over 20 years of experience in the financial services industry. Throughout his career, Sean has guided clients through a wide range of market environments, helping them navigate both challenges and opportunities with a disciplined, research-driven approach. Sean will start things off before handing it over to Rex. Today's presentation will cover economic data, inflation and the geopolitical landscape, markets, AI, policy and financial systems, and finally, portfolio implications. Our goal today is simple: to give you clarity in an uncertain market environment and demonstrate the thoughtful, disciplined approach that drives everything we do at Wealth. With that, please join me in welcoming Sean and Rex.
Remy, thank you very much. Thanks everybody for joining us on the call today. I've got some updates that I just want to quickly get through before we jump into the markets and economic data. So first, a milestone we're super proud of. Last week, April 28th, marked our 1-year anniversary. It's hard to believe a full year has gone by, but I wanted to thank every single one of you for the trust you've placed in us. None of this would have happened without you, and we don't take that lightly. Along those lines, I want to introduce, and for some of you, reintroduce Rex Weeks. Rex has recently joined the team, as Remy had already pointed out. We could not be more excited to have him with us. He brings the exact kind of energy, expertise, and client-first mindset we've built this firm around. And you're going to be hearing a lot more from him. As we close out the first year and look towards the future, there's one more change worth mentioning. I've been hosting these quarterly webinars, plus an additional ad hoc webinar here and there as markets demanded it since October 2008. If many of you were clients back then, and we had a full house at Monty's for that first webinar that we did live. That's a lot of quarters, a lot of charts, and a lot of coffee since then. Going forward, I'm going to be passing the torch of the webinar to Rex, and he's going to be doing a majority of the webinar content. I'll still be involved and you'll still see plenty of me, but Rex is going to be the voice you hear most often in this format. I'm confident you'll see why we're so excited to have him leading this going forward. I also want to congratulate Rick Spadero, who has recently been promoted to Senior Wealth Advisor. Rick has helped tremendously in this first year, and he's earned this promotion every step of the way. And the promotion reflects both the depth of his work with clients and the role he plays with our team. So please join me in congratulating Rick. One quick ask: in the next few weeks, Stephanie Catula has created a questionnaire that we'd like each client to spend a few minutes with, so we can get your honest feedback, and we'd be very grateful for you to spend a couple of minutes to do that. Your input genuinely shapes how we grow and where we focus. So please keep an eye on it. On the technology front, we're in the process of building out our new website, which will be replacing the landing page you currently see today. We'll have more to share on this as we get closer to the launch, but definitely wanted to let you know we're excited about the new website. And finally, some exciting news that we got a few weeks ago. We signed a lease at 3200 West Ray Road, a space that's adjacent to where many of you were used to visiting us at our previous firm. We'll be keeping everybody updated on the timing and any open house plans we have as we get closer to our move-in date, which should be late summer. So with that said, those are the updates that we wanted to update everybody on. And with that, I'm going to go ahead and pass it over to Rex.
Thanks, Ian and Remy, for the warm introductions. Definitely excited to be here and excited for the future. So thank you guys, and thank you for everyone who's in attendance for taking some time away from your very busy schedules. Like always, we have a good amount to go over. As I'm sure you've all seen, there's a lot that's been going on for throughout the last quarter and almost first half of the year. So I'll try to be brief, but obviously wanted to try to touch on everything at the same time. So I figured we'd start out with a definition given by ChatGPT. The first slide mentioned risk and uncertainty. So I decided to see what Chat had to say about uncertainty. It says uncertainty means that there are a range of possible outcomes and you don't know exactly which one will occur. We see it in everyday life, see it in science, probability, 70% chance of rain. You see it in decision making. It often reflects incomplete knowledge about consequences, risks, or future events. A useful way to think about it is risk is when you know possible outcomes and probabilities, while uncertainty is when even those probabilities aren't fully known. It's easy to say that we face many risks, but in reality, we face much more uncertainty as there is no way to know the exact probability that an outcome will occur. Two comparisons, like I just said, probability it will rain versus rolling a 6 on a dice. One, we can take a best educated guess, and one has a definite outcome of happening. So when we're thinking about markets and thinking about pricing uncertainty, there are a couple things that we can look at. There are a lot, but these are two of the main indicators that we focus on. The teal is the U.S. Economic Policy Uncertainty Index. It's a news-based index and counts metrics or mentions of policy uncertainty in newspapers, references to expiring tax provisions, and disagreements among economic forecasters. So this one captures uncertainty really about policy and what governments and central banks might do. The dark line is one you've probably heard of. It's the VIX, often referred to as the fear index. It's the implied volatility for the S&P 500 over the next 30 days, and it's derived from options prices. So how much it costs to hedge against market swings. Or the uncertainty as priced by markets. As you can see, they're generally in sync. When news gets noisy about policy, markets tend to price it in. There's a discrepancy that started to happen in Trump's second term, marked by that second gray area. The VIX is much more muted than what you would expect based on the U.S. Economic Policy Uncertainty Index. There are a number of things that have been going on, like I mentioned, tariffs, the geopolitical conflicts or war, fiscal questions, Fed independence debates. There are a lot of possibilities on why this might be happening. Markets may be underpricing tail risk. Investors may have become desensitized to the volatile swings in the market. The two measures might be measuring different things. The gap might be real. It's just been, they've been correlated for a long time, and now they're actually pricing what they measure. And then finally, it could be a warning sign. The VIX could start to catch back up with the uncertainty that we see in the news. Again, there's really, like we talked about, uncertainty. We're even uncertain on how to price this risk. So that's kind of, the theme of tonight's webinar, risks and uncertainty. And with that, we'll get into some of the meat and potatoes, starting with economic data. Looking at global growth, so this chart was updated by IMF at the 2026 World Economic Outlook Forum in April. The gray bars are pre the Iran war, the dark green are the base case that IMF presented, and the turquoise and yellow are the adverse and severe cases, respectively. In all cases, growth takes a sizable hit. On the left side, we have GDP growth. On the right, we have inflation. Like I said, in all cases, growth takes a sizable hit in 2026 due to the conflict, mainly attributed to the halt in traffic through the Strait of Hormuz, which I'm sure you've seen on the news almost every day recently. In 2027, we see that growth is not as affected in the base and adverse case. However, it could be reduced by a third if the severe scenario plays out. This would be marked by higher inflation, large supply chain disruptions that become more permanent and affect more areas of the market. Obviously, this would lead to businesses starting to hold or scale back in a slowing in hiring or even firing that starts. And then obviously higher rates to deal with the higher inflation. And the combination of the slowing growth and the higher inflation, known as stagflation, a term you may have heard before. And this really makes it difficult for central banks because the two sides of their dual mandate, growth and full employment, and then inflation, making sure that's tamed. So you can't really lower or raise rates to fight both because you're on both sides of that mandate. So that's moving on. That's kind of what we've started to see. So the Fed, the Bank of Japan, the European Central Bank, and the Bank of England all held rates steady at their meetings last week. 3 out of 9 of the members of the Bank of Japan board dissented and argued for a hike, while at the Fed, 4 out of 12 dissented, 1 wanting a cut, and 3 wanting to drop language hinting at future cuts. Bank of Japan also slashed its growth forecast in half and raised core inflation outlook by 0.9%. So we're starting to see some of the projections that the IMF updated already. In Europe and the UK, they're preparing to hike, but again, they went on pause because of the uncertainty surrounding the war and the energy shock. And same thing in the US. We're kind of in a wait-and-see mode. This is a stark difference from earlier years when a lot of the banks were moving in sync. You'd see a lot of the banks, in the graph on the left, you can see when a lot are raising rates or steady or cutting at the same time. You start to see the shift where the central banks aren't moving in unison as much. And then the chart on the right, the debt to GDP. So you'll hear people mention when the level, I think it was recently in the news, that the U.S. level got over 100%. This isn't necessarily a problem. Some of these countries have been operating above this level for a long time. It's more about how they've gotten to this point and where they go from here. So an example I like to think about, if you consider a family with $100,000 in debt and an annual income of $100,000, if the family ran up that debt due to a one-time purchase that isn't growing and isn't fixed, like financed at a high rate, they're probably going to be okay, right? They're probably going to make their monthly payments and eventually pay down that debt. If the family financed at a high rate, if they plan on continuing to raise more debt and have stagnant income, this is where it becomes a problem. That debt is something that family has to worry about. It is at the constant forefront of any conversation they have, and that's kind of the worry that some economists are having with how quickly these debt levels have begun to risen in some countries, including the United States. Moving on specifically to U.S. growth. So this is from 2023 to Q1 of this year, looking at U.S. gross domestic product, or basically how much we've grown. So we grew at 2% annualized rate in Q1, below the 2.3 expected growth. Most of the growth was attributed to business investment in personal consumption. Personal consumption, we know it's a mainstay in our growth. We're a consumer economy, a services economy. The business investment was fairly large for last quarter, and that's due to the AI build out. So AI spending has been a topic of conversation for a lot of these earnings calls for these hyperscalers, and it's pushed our economy forward, especially in last quarter. The largest drag was net exports. So this comes from importing a lot of, again, AI. You're going to hear a lot of AI on this call. Importing a lot of AI chips and the inputs for these chips from other countries. Government purchases rose at 4.4% rate in Q1. There's a catch up from the contraction caused by the government shutdown late last year. And if you remove this, growth was actually only at 1.5% for the quarter, which is a bleak number. Core GDP, which strips out, like I just mentioned, the government purchases, inventory, international trade, the more volatile parts of this reading, that core GDP number rose at 2.5% in Q1, which would be the same as a year ago. Prices for GDP rose 3.3% from a year ago, which is well above the short-term rate target that the Fed has set. So that will remain, it'll remain there as the energy shock continues to make its way through the data. And of course, the longer the conflict is on for, the longer we'll see that effect. Something that's also been in the news a lot, people have been talking about, is K-shaped economy. So we have three different graphs here split into two parts. On the left, we have low-income households experience higher inflation. And then on the right, we have the same relationship between bottom 40%, well, it's split out differently, but the relationship for real net worth and financial assets and how they've grown since Q1 of 2023. So for inflation on the left, we really want to think about budget consumption. So low incomes spend more of their income on necessities like food, energy, rent, categories that have spiked the most from about 2021 to 2023. And on the other end, top 20% of earners spends on services, travel, discretionary goods, which inflated much less during that time period. So if you think about it, we're talking rent payment versus mortgage payment, something that you have to, renegotiate every so often versus something that's fixed. The lower income cohorts usually have less substitute flexibility, limited storage or bulk buying, and even geographic concentration. So the lower income cohorts that are in small cities feel the price shocks more than those living in big cities where they might have more substitutes or more freedom to shop around. On the right, the wealth inequality has been growing since 2022. As of Q4 2025, the top 20% held nearly 72% of total household wealth. So this is obviously something that we've seen since the end of COVID. A lot of the people that are participating in stock market and financial assets are seeing their net worth grow at a much higher rate than the lower cohort of income earners. The largest share of wealth held by the largest share of wealth held by the top 20% of income earners since data tracking began in 1989. So we're at the K has continued to grow, and we're actually at the most extreme level we've seen. It sounds alarming, and of course it's not great for the people who are suffering and feeling the pain of these facts, but wealth distribution has always been disproportionately skewed to higher income individuals. Spending of the top two quintiles peaked in 2015 and reached a low point in 2020. You see this arrow pointing, it highlights the 2021 to 2023 recovery. So the consumption by the top earners has started to grow again. And the top earners reclaiming a larger share of total consumption as inflation, asset gains, and uneven wage growth widen the gap. So those three things we looked at on the last slide, again, are just increasing the size of the K, but it's really just getting back to the trend line that it was already on. And staying on that topic, the sentiment sharply diverged when you look at wealth stock ownership that we just touched on. Specifically, people in the top third, they came in at 75.2% or 75.2 confidence versus those with no stock ownership at 51.3, which is a new multi-year low. Like I said, become decoupled significantly since early 2024. Stockholders have recovered as markets rally, while those with no stock have seen a slide and stayed at depressed confidence levels. Some overall survey numbers that come out might show or might not show the pain that the majority are actually feeling. Like I said, this is obviously a problem, but the question is when or if this will eventually impact the overall market. Moving into the labor market, which has seen a lot of uncertainty recently. You can see the chart on the left, the total non-farm payrolls. The lines have gone up and down for the better part of almost a year now. Each month seems like it has an equal chance of being negative or positive. In January, we had a $160,000 raise. In February, we lost $133,000. In March, we gained another $178,000. Obviously, you can see the volatility there in itself. That comes out to $68,000 gain average per the first 3 months of the year. For decades, we needed to add more than 100,000 jobs a month just to keep unemployment from rising. Now it's close to zero, allowing for a near zero growth while holding on to full employment. There's a couple of things that are making this true. Baby boomers are reaching retirement, so we have a large amount of the workforce that's falling out of these statistics, and then the smaller generations are aging into the workforce. So you're not replenishing as many people as we're losing in these job numbers. Also, with the new administration, there's been strict restrictions on immigration. We're at near zero for immigration, and as Welts mentioned before, that's been a large part of the growing job force in the United States over time. We're trained to read these weak payrolls as warning signs, but this could lead to policy mistakes. Market bounces between gains and losses, like I said, with no clear signal of either strengths or weaknesses. And then if we talk about the AI impacts, a lot of people are pointing to AI with these wonky numbers that are coming out. Goldman Sachs released a report recently that puts an asterisk on this fact. They found that AI reduced employment in occupations that are easily substituted by AI, but increased employment in jobs augmented by AI. So roles that require human judgment actually benefited from using AI. And they found the final finding was that AI only raised unemployment rate by 0.1%. Obviously, we're at the very beginning of this AI journey, but for now, it looks like AI doesn't have as negative impact on the jobs market as people first thought. Later in the study, they analyzed some earning calls, and they've come up with this term AI washing. Companies are saying that they're cutting people, making cost-cutting moves due to AI, when that's really not the case, but then markets are rewarding them because anytime anyone hears AI in an earnings call, it leads them to believe that they're growing and that their earnings are going to increase. On the right, unemployment remains low and initial job claims remain below recession levels, so both of those are good on the indicator front. The bottom line here is AI impact in the labor market is small so far and more complicated than people think. A lot of different things to look at. And the labor market is softening, but not breaking. And it's in line with the no hire, no fire phrase that we've heard over the last year. Obviously, with it being part of its dual mandate, something the Fed will need to keep a close eye on. Moving off that, productivity. So output and productivity are two main pieces of potential output growth for a labor force. AI is already boosting this, especially in knowledge work. So we've got efficiency gains, task automation, innovation and output. So new products, faster research and development, and lower costs of experimentation. So it's less about fewer jobs and more about different jobs and different winners. So it's not hurting the job market, but it's transforming it for sure. If AI scales, it can lift trend productivity growth. This would lead to higher GDP growth and higher real wages further down the line. Again, this is only if these gains are broadly distributed and not concentrated amongst one sector. Moving on to inflation. So CPI was up 0.9% month over month on a seasonally adjusted basis, bringing the annual inflation rate to 3.3% in March. This is the highest since May 2024 and the largest jump since June 2022. As you can see, it's that green bar that sits at the top of the March reading. That green sector is energy. And if you remove that energy piece, it looks like the inflation reading would come pretty much in line with what we saw in January and February. So this is due to gas being up 21.2%, which is almost 3/4 of the monthly increase for all items. Obviously, I'm sure you all know the gas prices have been increasing. The national average actually got above $4 a gallon for the first time in over 3 years. When we strip out the more volatile pieces of inflation, just looking at core CPI, that rose, or it was up to 2.6%, up slightly from 2.5% in January and February, but below the 2.7% forecast. Like I said, it strips out the more volatile pieces like energy and shelter. The market is pricing in now with this energy shock. The market is pricing in 0 rate cuts for the rest of 2026, and actually boosted the probability of a rate hike up to 52% by the end of the year. Of course, that's subject to change. We had some news today that there might be a breakthrough in the peace negotiations, so those probabilities vary subject to change. On the other side, like I just mentioned, where yields have gone, so this is since the beginning of the year, we have the 30-year rate at the top in blue, the 10-year rate in orange, and the 2-year rate in purple. And then at the bottom, that straight line is the effective federal funds rate based on where their range is currently. Bond yields have been rising due to oil-fueled inflation fears. The 10-year, which is often used as the benchmark rate, rose as high as 4.48% in March, and we saw roughly about a 50 basis point jump in just a few weeks. The 30 and the 3 also soared in March to highest levels since August of last year. We saw a brief ceasefire dip in April, and that's, like I said, these things can change, flip of a coin. When that ceasefire happened, the rate cut odds jumped from 14% to 43%, and like I just said, recently they moved back down to 0. There are a couple drivers here, right? Inflation expectations are the main one, but then the Fed expectations, which feed off of that, and the term premium that are baked into these rates as well. The main point here, all these rates are above that Fed funds target, or that Fed funds effective rate of 3.64%, and well above the Fed's target of 2%. So that's why a lot of people in the probabilities say that the Fed isn't going to cut and that we can see more of this higher for longer that we've been experiencing. Now we'll move into the geopolitics. So the conflict overseas that I've mentioned, the Iran/US/Israel conflict of 2026, the conflict started the Operation Epic Fury on February 28th. And since then, this multiple, supreme leader has been killed. Couple of his descendants as well. We have had the Strait of Hormuz restricted. The peak drawdown there around March 29th was an 8.88% drawdown. Then we had a ceasefire declared. We had a naval blockade. Ceasefire was extended. A bunch of Project Freedom was announced, I think yesterday and 2 days ago, and then today it was suspended. So again, a lot of volatility, a lot of uncertainty with what's going on overseas. The main sticking point in these negotiations are, we would like the Strait to be open, Iran to cease its nuclear program, while Iran would like the U.S. to remove some of its troops out of neighboring countries and to release any Iranian frozen assets. During all of this, like I said, it's already snapped back as far as markets are concerned. That the S&P is now up 7.5% year to date, but things have been extremely volatile in markets. Like I said, gas and energy being the fulcrum there. Speaking of gas, people are paying at the pump. Like I mentioned before, we raised above that $4 mark. A lot of the talk about changes in policy made last year that would provide larger tax returns and boost consumption. That may not be the case. There are two items there. Tax returns aren't as large as they were first projected when the Big Beautiful Bill Act was passed, along with some of the tax cuts that went into effect. And two, the higher costs that I've mentioned multiple times, especially gas, are cutting into these returns that would have otherwise gone to paying for necessities or even hopefully paying down some people's debt. This chart just drives that point home. The bottom, that last blue bar, the bold, the average per return at 611, and then the black bar showing the estimated gas costs at 857. So the increase at the pump more than covered the relief that the average person was supposed to get from these tax cuts or tax refunds. We see the K shape here as well. Those making 126,000 received returns much higher than the cost, while lower middle class families were adversely affected. And the boost that they were supposed to get isn't even going to cover this unforeseen consequence, or not unforeseen consequence, but the consequence from the conflict in Iran. Silver lining here, obviously, it's hard to call this a win when there's conflict going on at any time, but including the U.S.-Israel airstrikes that we carried out on 2/28, there have been 22 airstrikes in the last 40 years in the Middle East or North America, Africa. During 8 weeks following Operation Fury, which is the one we just carried out, the S&P gained over 4%, which is in line with the prior 21 strikes median in average. So the bounce back we've seen even in the 8 weeks post beginning of the conflict is in line with what's happened every other time this happened. Not saying that's what's going to happen every time, but so far it's kind of following the same playbook. Equities have done well in subsequent one-year periods. That's the graph on the right, with average and median performance over 16 and 18% positive turns. Next, move on to markets. So I want to start off with a little algebra equation. It's just showing, basic breakdown of what should make up a price. So we have EPS, PE ratio, and then the value of a dividend. EPS and PE is the earnings component, basically the value of the company's earnings. PE is how much an investor would pay per $1 of current earnings, or the market's opinion on what the company is worth. And then dividend per share obviously is the real money that a company is paying back to its shareholders. So the first part of that equation, or one of the first pieces I just showed, was the PE ratio. This is for the S&P 500 specifically. So the forward 12-month PE is currently sitting at 20.8, well above the 30-year average of 17.2, which we've seen, if you look back on this chart, it's been at least one standard deviation above for the last 2 years, and it's been above the 30-year average since, let's call it the middle of 2022. So we've been elevated for a while. Looking at the CAPE ratio, which it's the same measure but takes into account inflation, it's even more overvalued at a 40.5 clip compared to the 28.7 30-year average. And then dividend yield, well below. So that real money that's getting paid out by these companies is well below the 30-year average. And then the EY spread, or the earnings yield, which is the earnings yield minus the yield on an investment grade bond, is actually negative. So you're not getting compensated for the risks that you're taking in the equity market, specifically the S&P 500, and you can earn more on a risk-adjusted basis by investing in quality bonds at this time. The PE ratio, you can see it took a bit of a dip to start the year, but it wasn't really felt in markets, and that's because the other piece of the equation was propping up the price, and that's the earnings. That was the second piece in the algebra problem we looked at. So in Q1 of 2026, with 63% of companies in the S&P, having reported, 84% have reported positive earnings surprise, and 81% have reported positive revenue surprise. The year-over-year earning growth rate is 27.1% currently. If that holds, it'd be the highest growth rate reported since the fourth quarter of 2021, when it was at 32%. So earnings have, with this AI build out, they have been shooting towards the moon. Last quarter, we saw a lot of the hyperscalers, they dropped down in the aftermarket after reporting enormous CapEx spending plans. It was a show me kind of earnings season, and people just saw spend and they didn't really see the revenue. It's starting to flip. So Alphabet, Microsoft, Amazon, and Meta all announced increased spend on AI build-outs, so matching what happened last quarter. But and that was up to $700 billion in spend between those companies. The difference is Alphabet reported an 81% increase in profits, and the user base grew 40% quarter over quarter, which caused shares to jump 4% in after hours. Meta raised estimates for CapEx, but revenue guidance was only in line. Shares fell 6%. So we're seeing some of these hyperscalers. It's not really a mention AI and your stock goes up. It's really a show me the money kind of environment that we've moved into, and we might start to see a lot more winners and losers. Moving into policy, so there's been since the Trump administration came in, we saw it first with Liberation Day, and then we've kind of seen a mirror image looking at the Iran war. The market itself is kind of acting, it's called a break on policy. So the negative market movement that we've seen after Liberation Day kind of forced Trump's hand in delaying and even walking back some tariffs. And we've seen a similar playbook with the war in Iran. So both moves can be summed up by the newly coined term, the taco trade. Trump always chickens out. It's been seen in both instances that he's wanted to do something, and then the market kind of forces his hand to walk it back or go a different way. Markets have not priced in a long-lasting energy shock because they believe that the president wants to prevent that from happening, which kind of goes hand in hand with what I just said. And then investors have also been conditioned to buy the dip, which goes into that being desensitized theory that I mentioned at the beginning. And we've seen this as every policy reversal is getting absorbed faster and faster than the one before it, with these deep V-shaped recoveries that are becoming more popular. Touching on the Fed, so there's been a lot of news regarding the Fed. There's a new Fed chair, Kevin Warsh, who's coming up for confirmation, It's now being priced into some of these prediction markets that he'll be confirmed by mid-May. He served on the Fed board from 2026 to 2011, including during the financial crisis. He acted as kind of an intermediary between Wall Street and the Fed during the Great Recession. Some of his beliefs, so on the Fed balance sheet, he says the balance sheet disproportionately helps those with financial assets, while the interest rate tool hits the entire economy. So he's in favor of a smaller balance sheet. On inflation, he believes it's more tied to excessive spend and growth in the money supply. So he supports it looking at alternative measures like median, or trimmed inflation. And then on Fed communication, he's in favor of less communication, less press conferences after every decision, and in favor of no dot plot. So he believes that the more communication you have, the Fed has either verbally or the more documents it puts out, the more anchored the Fed will be to do what they said are right. So they'd be less able to move based on what the market says. So that's what his argument is on those fronts. And with that, obviously with the new Fed chair, that would mean Jerome Powell would be leaving. That is the case on May 15th. His term as Fed chair ends, but at the last Fed meeting, he disclosed he will remain on the Fed board after his term is up on May 15th. He's the first Fed chair to do so since 1948. He referenced the events over the last 3 months left him no choice but to remain close to ensure the central bank continues conducting monetary policy without political interference, which has kind of been at the forefront with President Trump almost begging him to cut rates since he's been in office. Powell would also fill a seat that would otherwise been taken by a Trump nominee. So we have this split you see on the screen, kind of red and blue, between those who probably would be in favor of lower rates in the top, which not necessarily higher rates, but more wait and see environment. So we might see a lot of dissents moving forward with these Fed meetings. Again, I warned you we'd talk about AI. I've been talking about AI, and we will probably continue talking about AI in market webinars to come. There's a lot of opportunities and risks with the build out. I've mentioned a lot of these. Don't want to spend too much time here, but I'll list them out. So the opportunities, productivity, the spending drives economic activity and growth. Defensible moats forming, so it's good for some of these companies and good for the U.S. if our companies win the AI arms race. And then innovation diffusion to the broader market. So like I said, filling AI, spreading into other sectors, and not just being concentrated in one area of the market. And right on cue, risk, concentration risk in a few names, capital intensity and ROI uncertainty. So a lot of spend and no, it's not 100% probability that all of this is going to work out or lead to tremendous growth. Power infrastructure bottlenecks, we're already seeing some local energy prices skyrocket in some places where data centers are being built out. And then rich get richer, like we mentioned, that K-shaped economy gets even worse as tech CEOs make a lot of money and low-wage workers are displaced or fired. I just wanted to put these two pictures in front of you guys to show the vast scale of what's happening and just how quick it's happened. So on the left, we have data centers versus other mega projects that have happened. You see the interstate highway system, railroads, International Space Station, the Manhattan Project. Data centers, about $930 billion in 6 years spending-wise, which, as you can see on that graph, is crazy. On the right shows the concentration. So that's a chart of the U.S. semiconductor market cap weighting in the S&P 500. It's gotten, after today, it's probably even higher, but it's gotten above 14%. This doesn't even account for real estate, for data centers, construction companies, etc. that are all pretty much correlated to this AI trade. So if we see any pushback against that trade, obviously semiconductors will get hit, but a lot of other areas of the market that are now connected to this trade will see pain as well. More on the technological disruption. So there was an article, behind the curtain article on Axios, listed these 6 kind of facts that have happened fairly recently. So in the last 3 months, AI is now the fastest growing product in the history of the world. Mythos, a new anthropic model, is so powerful it's not being released to the public. Models are building themselves. There's little to no transparency, so something is growing so fast and so complicated that it's difficult to create rules and regulations around it. In April, Sam Altman, the CEO of OpenAI, his home was the target of 2 attacks, and he himself even said, fear and anxiety is justified, power cannot be too concentrated. And then the last one was the great software rout that erased almost $2 trillion from the market in a matter of weeks. So like I said, all this AI story is connected, and if it's proved that it can wipe out a sector, that it's not feasible, or that we spent too much, we can see a lot of wealth wiped out very quickly, and that could cause problems for the whole market. Moving to financial systems, so just want to touch on a few quick pieces. I'm sure you guys, a lot of you have seen or heard of the growth in private credit as an asset class. I know I've been asked about it a lot. A lot of salesmen emailing me about the new greatest thing. It may as well could be, but the trajectory with which it's grown mirrors non-agency mortgage-backed securities leading up to the 2008 crisis. Again, not saying that's exactly what's going to happen. Again, it could become a suitable asset class within a diversified portfolio, but with the speed at which it's grown, there's not a lot of regulation around it, not a lot of transparency. We saw that a lot of these providers had redemptions, Cliffwater, Blue Owl, Blackstone, Apollo, some of these big names that have been around for a while. There's been a push to get retail investors into these funds, and once panic, that's the nice thing about when they're private, there's lockup periods, which is a good and bad thing. You don't have access to your money, but it also prevents a run on the fund where the fund gets drained of a lot of its liquidity and AUM overnight, and that's kind of what happened here. So the dark blue or the light blue is unmet redemptions, dark blue is redemptions honored. So you can see of the top 8 firms, 7 were unable or unwilling to fulfill 100% of redemption requests. So they were restricting investors' access to their funds. There's been so much stress on this sector that banks are now trading derivatives on private credit. So people are betting on it failing. Good news, the sector still represents a small portion of U.S. financial assets, even with its outsized growth. Bad news is, as we've seen before, sectors can become more correlated, meaning a downturn in one could push other areas lower. And again, that's what we saw. There was a scare where one of these new AI programs was going to basically wipe out an entire sector, the software sector. And then it came out that one of these private credit funds was, I think 40% of their exposure was to software, which, again, because there's not much transparency, much reporting, investors weren't aware of that. And when they found that out, they got spooked and that's when we started to see a lot of these redemption requests. Another hot button topic, which I'm sure a lot of you have heard about, prediction markets. Again, another market that feels like it's exploded overnight. Over the last year, Kalshi, one of the more popular ones, is up from 100 million in volume to 3 billion in volume in just a year. first gained popularity in the 2004 presidential election. I think I even remember watching the news, and it was the first to call the race before Fox, CNN, or any of the news outlets. Um, Again, with how fast they've grown, there hasn't been much time for proper legislation to be passed. Many see them as another form of gambling. Their argument is that you're trading with another person a contract for something. So there are a couple situations that are kind of scary that show that manipulation is going on in these markets. And again, when something's brand new, it's more susceptible to be manipulated. So on April 22nd, there was one Senate and two House candidates that got suspended and fined for betting on their own election outcomes, which led to 6 days ago the Senate unanimously banned members and staff from using prediction markets. And then there was a situation in Paris in April where a sensor at an airport was manipulated, causing it to spike. It's like at Sky Harbor here in Arizona, it's where we get our main temperature read for the city of Phoenix. So in Paris, somebody used a device to heat the reading and push the temperature up to something that they had bet on that had a slim probability of happening. One bettor won $34,000 and another won $37,000. So again, we're seeing more and more areas pop up where people are taking unnecessary risk, where manipulation is going on, where things are happening kind of in the shadows, that aren't necessarily good for traditional markets, because it shows that people are okay right now taking on unnecessary and clouded risk. On Polymarket alone, traders lost 131 million over the last year. So again, a lot of risk taking going on in kind of gray corners of the market. And with that, I'll pass it back to Sean so he can talk about how this impacts investors in our portfolio.
Sure. You want to go ahead and go one more slide there? There we go. So all this stuff that Rex has been talking about, current events, the war, the conflict, AI, all of it's happening very rapidly, and in history, these types of things have happened consistently. Uncertainty is not a new thing. So when we look at portfolios, we want to go back to fundamentals. And one of the fundamentals that we rely on is looking at long-term capital markets assumptions. And so if we look here, this is the teal is JP Morgan's 2026 long-term capital markets forecast. You can see for large cap US, they're forecasting 6.7% on an annualized basis over the next 10 years. For mid caps, 7. For small caps, 6.9. For international, a slightly better 7.5. Emerging markets, 7.8. And then we have US aggregate bonds at 4.8%. Next to the teal is the darker, I guess, bluish greenish color. That's the actual 10-year realized annualized return over the past 10 years. So somebody who's been in large cap US for the last 10 years has earned 14% per year. And going forward, we expect 6.7. So there's a big expectation difference here. What drives our investment decisions is this long-term capital markets forecast, not just expected return, but we also look at expected risk from each of these areas. And then we look at how each of the areas are correlated to each other. So if we're in an environment where we expect 4.8% from US aggregate bonds and 6.7% from large cap US, and we have to take 2 or 3 times the risk to get the 6.7% in large cap US than we do the US aggregate bonds. Well, we may push a little bit more of the portfolio to the safer 4.8% expected return versus the more volatile 6.7% return. In the grand scheme of things, our long-term capital markets assumptions have changed in the fact that over the last year and a half, some of the areas that we were expecting higher rates of return, they actually earned higher rates of return in 2025 and 2026, and I'll dive into that when I go through the returns that we saw in these asset classes more recently. But it's driven because those areas have done well. It's driven the future expectations to come down, and now we have international and emerging markets that were in the 8%, maybe two quarters ago. Now they're more in line with domestic returns, and therefore are less attractive than they were before, and that's because they've performed very well over the last, call it 15-16 months. So this is going to drive our decision on where we're going to overweight or underweight the portfolio, and you can see there's really not a dramatic shift either way. For equities, the lowest we have on here is large cap at 6.7. The highest we have on here is emerging markets at 7.8. And then bonds are coming in at 4.8. So it's really a clustered story here, which tends to force us to look at, okay, well, if we're going to get the same rate of return, if we're expecting the same rate of return over the next 10 years with not a lot of variation, then what do we look at? We look at risk, and that tends to push us towards maybe safer investments in the current environment right now. Go ahead into the next chart. This chart just tries to show what's worked over the last 10 years may not work over the following 10 years. And I love this chart because it really shows. You've got 1985, you've got the top 10 companies, and they're all green. And then you can see in the next 10 years, there's less green. And the next 10 years, there's less green. And the next 10 years, there's only 2 greens. And in fact, in 2025, there's not a single green company there. And you can see that with the gray, and you can see that with the blue. And now, right now, if we look at the current top 10 companies, most of them are purple, which are the newer companies that we've been talking about. And what I like to look at this is, okay, well, let's say the next 10 years is going to be teal. Well, we may not even know what 10 companies those are. We might not even know what those companies' names are. What will the next 10 years bring? We have no idea. Probably some companies we've never heard about. And that's where we want to look. Go to the next slide, Rex. Which brings me to this next slide, which shows that, and when I saw this slide, I had to kind of do a double take. 29% over the last 100 years, these 10 companies are responsible for 29% of the wealth created over the last 100 years. If that's a very small number of stocks that are representing 30% almost of wealth creation in the United States. That tells me it's very difficult to know which which one of these 10 companies you needed to have in your portfolio ahead of time. Think to the previous slide, because they change. And companies that come out of this AI boom are going to add lots of value and lots of wealth, and we may not even know what those companies are. And so what this slide is telling us is, look, we want to make sure that we're invested in a broad base uh, of a lot of different companies, so that the ones that end up really hitting home runs, we own. Because if we're missing a couple of these, it can really be detrimental to our portfolio. And another way to look at this is, how many companies over the last 100 years have outperformed T-bills? You would think a lot of stocks on a per name basis would outperform T-bills, but in fact, 59% of companies, of stocks, underperform T-bills. 41% outperform. This just tells us it's very hard to know which companies are going to outperform and underperform. And there's a lot of companies that actually underperform T-bills. So we don't want to try and pick winners or losers. We want enough exposure to companies so that we make sure we get these winners, because the winners really are outsized creators of wealth. Next slide. Valuations are elevated, but less than the start of the year, because, as Rex said, earnings have really increased this last quarter. Outside the United States still looks more attractive than inside the United States, but less so than it was maybe a year ago. Go ahead, Rex. Yield to worst. So this just tells us starting yield from different bonds. It gives us a valuation metric, if you want, on bonds, and you can see that rates are up. We've had an increased interest rate basically since COVID, and then in 2023 we had peak rates, and they've come down slightly, but not a lot. So rates you're still getting paid in some of these fixed income areas a lot more than we have over at least the past 15 years. And bonds are giving us an alternative to stocks, especially expensive stocks. The starting yield that we have in the portfolio is very correlated to the 5-year return on a bond. So you can see right here, as of yesterday, the current yield of the Bloomberg US aggregate was 4.65%, which implies that we'll earn about 4.69% annualized from that asset class over the next 5 years. Starting yield has a lot to do with our 5-year return forecasts. That's just telling us, again, bonds at lower risk and 4.6, 4.7, 4.8% expected returns over the next 10 years. They're not a bad place to sit, earn income, and see what's going to happen with equities, and maybe get a better entry point to some of these equities. Now, on the same token, you don't want to try and time things, because if we would have moved all of our portfolio to fixed income when we thought equities were expensive, we would have missed out on some of these on some of this equity outperformance that we've seen over the last several years. 2023 S&P up 26%, 2024 S&P up 25%, 2025, S&P up 18%. Now, one thing that has changed from 23 and 24 is we had outside the United States in 25, emerging markets up 34.4% in 25. Developed markets up 32% in 2025. And then again in 2026, emerging markets 18%. So emerging markets since the beginning of 2025 is up over 50%. That's definitely a reversal of where emerging markets were in 23 and 24. Lots of people were upset with us because of our emerging markets exposure in 23 and 24 versus the S&P. Well, in 25 and so far in 26, folks are much happier that we have large exposures to emerging markets, and same with developed markets over the last 15, 18 months because they've done a little bit of a catch up. It's not about which one of these is going to have the best performance. Again, it's not about one versus the other. It's about owning all of them in a way where we can reduce the volatility of the overall portfolio without giving up a lot of the return. It's my son is super into golf recently, and I'm trying to tell him that consistency is much better in golf, and trying to tell him, look, you want to be able to hit it right down the fairway. This asset allocation portfolio is a mix of all of these asset classes, and you can see 2011 to 2026, the asset allocation portfolio is never the best performer. It's never the worst performer. It's right down the middle for the most part. And it has given us since 2011, it's given us 7.3% average rate of return with a volatility of 10.1%. That is a good trade-off, getting 7.3% with only 10.1% volatility. That's a really good place to be, and that tries to show you the benefit of having a lot of these asset classes, because we never know. We look at 2011 to 2025. Well, yeah, if we would have known that the S&P 500 was going to return 14.1% with an volatility of 14.7, we would have had a tremendous amount of allocation towards large cap. The problem is at the beginning of this period in 2011, we were just coming off the great financial crisis. We were just coming off of a 10-year period of time where the S&P 500 over a 10-year period lost money. One of only a couple of times in history over a 10-year period of time that the S&P lost money. So it was very hard to think about the S&P at that time and say, oh, the forward-looking return is going to be a lot higher. Now, we had a lot more exposure to the S&P 500 back then, and it was hard to convince people to have a higher exposure to S&P in 2011 when we were coming off of 2008, 2009 scenarios where we just went through the great financial crisis and had very bad S&P 500 returns. So again, we want to look at this as not trying to predict which one's going to be the best. We just want to put these together in a way that we're going to get a good, acceptable return for the risk that we're taking. And then the last slide here is just match your risk with your time frame. If you've got 1 year, you really shouldn't be in stocks. You shouldn't be in bonds. You shouldn't be in a 60-40 portfolio. There's too much divergence in outcome. We've got the possibility of big losses over a 1 year time frame. If you've got 1 year, put the money in cash. Right now, cash is earning right around 3%, and you can get 3% without any risk, knowing in a year from now if you put 100 grand in there, it'll be worth 103 grand in a year. If you've got more than a year, if you've got 5 years, okay, now we can start talking about adding risk to the portfolio. If you've got 10, now we can even add more risk to the portfolio. There hasn't been a 5 or a 10-year period in the last 75 years where a 60-40 portfolio has lost money. Now we're putting the odds in our favor. If we've got 20 plus years, now we've got to be looking at equities, because we're getting the highest return. And we know that if we have 20 years, there hasn't been a 20-year period of time for equities where we've lost money. So that's we want to match our time frame with our risk, and that's exactly what we try and do for our clients. So with that, we're going to go ahead and open it up to questions. If there's any questions, we're going to have Remy read off the questions, and we'll most likely have Rex or I answer any questions. Remy, do we have any questions?
No, at this time we do not have any questions. I want to thank Scene and Rex for giving us these really important insights. It certainly leaves us with a lot to think about moving forward. We appreciate everyone joining the webinar, and we look forward to seeing you at the next one. Thank you.
Thank you, guys. Take care.